Welcome back. And commodities in a portfolio is a question, or rather a debate that we have seen going on, raging rather, across global markets with the way the commodity prices have been moving and with the way the funds really are making a killing in sense of returns there as well. So this one is to you, Vikram. I do understand, as Lakshmi also said, that gold and silver is perhaps we are at right now, and that also just about on the surface. There are various whole host of commodities. I mean, international markets are making a killing when it comes to cocoa, which is at all-time highs, or a coffee, which is trading at an 18-month highs, or a corn or a palm oil. I mean, where is India when it comes to all of these price moves?
So let me tell you how the introduction of gold and silver ETF has affected the domestic commodity markets. So today, we don't have a spot exchange as far as gold and silver is concerned. So gold and silver ETFs have become a proxy spot for the Indian market, the listed spot. Otherwise, rest all the spot prices, whether from the exchange or from the various association, it's a derived price. But here is a security which gives you the perfect spot price as far as the Indian market is concerned. Also, instead of buying gold and silver bar and shoving it under your mattress, they remain in the financial market, which provide the liquidity, and they can be utilized for a lot of stuff which you cannot do with gold and silver offline. So I think this is one thing which is underappreciated as far as the gold and silver ETFs are concerned. Its contribution to the local market in terms of liquidity and everything else. So I think once we have similar products in other commodities, whether it is energy or softs, it'll have a significant impact on the local liquidity, and also it will result in the cost going down. And maybe even if you don't have a spot price, these ETFs can act as a proxy for the genuine spot prices in India. So I think that is something which needs to be done for these things to take off. Otherwise, if you only have futures and options, which will have today 90% of the liquidity in all exchanges and derivatives is through algo trading, which is not dependent upon any sort of fundamentals. So you need physically backed products which sort of provide the real story, the real picture of the market.
Vikram, very well said. But when you look at the Indian markets itself, we have a futures and options, yes, and then we have ETFs and funds as well coming in. But it took a very long time for gold to just get in there. Silver has taken another few years, and now we have that as well. How soon, how much before we get metals, energy, and all of these softs? Would you say it's a very, very slow process with what we're going through?
I think we, as a fraternity, the investment fraternity from the fund side, I think we are equally responsible for the slow of, process, because, these things have to be driven at the, at the association levels. So unless there is a trust, I mean, you have to understand, appreciate the regulator has been fairly brave enough to approve commodities in mutual fund 4 years back. Considering what happened in the commodities not too long before that. So I think it's really appreciable what SEBI has done despite, all the apprehensions. And obviously the fund houses have done a good job in, living up to the expectation in terms of safety, security, liquidity, etc. But I think in a way, right now it is not a focus. As Lakshmi mentioned that, we are still an equity driven market. But I think I always believe, fix the roof before it starts leaking. So, if you want to double your size of the economy, in percentage terms, the commodity consumption may not skyrocket, but in absolute terms, it will be some gigantic numbers. I mean, today you're consuming 5 million barrels of oil per day, 800, 900 tons of gold, 900 tons of gold annually. So if the economy size doubles, well, the 5 million will not become 10 million, but you're looking at somewhere around 7 or 8 million barrels per day of oil, 1,200 tons of gold. So it may not show up as a higher number in the current account deficit, but it will be very, very high in absolute terms. And it is not easy to find those commodities on tap. So I think this is a time where, whether it is the regulator or the associations and the various, stakeholders to get together and plan a roadmap so that in the next 5-10 years, when we are there, we don't have to, sort of look for clues what to do at that point of time.
Lakshmi, what's your sense also on what really needs to be done? One, and second is, with whatever commodities that are available right now with the funds, how much of that should be a part of your portfolio?
So, Manisha, to your first part of the question, Rome was not built in a day. It took really a long time to get gold and silver into the country, into the ETF format. And obviously, precious metals is something which even the retail investor understands. Whereas if you talk about the other commodities, specifically the energy pack, which is largely crude oil, or for that matter, base metals, it's predominantly understood by the institutional investor and maybe traded if possible, by the retail investor as well. So I think making some of these in a basket format available could be a starting point, and I think it's a happy add-on to have as part of the portfolio. But as I said, and that ties into your second part of the question, how much of these kind of funds or categories can one have into the portfolio? Well, I'd still maintain that these are all complementary, add-ons to your portfolio. Can it be the core? Very unlikely given the cyclicality of each of these commodities at varying times and points. You're seeing gold rally today, but has it always been the case? Well, answer is no. So I think focus on core wealth creation, which is predominantly done through equities, have stability through fixed income, but definitely there are opportunistic, options available through commodities, and one should definitely look to harness that, especially in times like these, where almost every commodity is shining.
Lakshmi, let me put this question another way as well. Would you call commodities a good diversifier in a portfolio?
Most certainly, definitely yes. It is a diversifier to your portfolio. Be mindful of the risks for sure, because some of them just kind of jump into a bandwagon without understanding the risk. But certainly, diversity it does offer.
When you talk about equities, and yes, we lean way too much onto that, but when it comes to gold versus the gold companies, whether it's gold loan companies or jewelry companies, we do see a lot of interest into that one. Do you also see, in some sense, as we move forward from here, of people understanding more of the underlying commodities? Because yes, whether it's a tire company or a sugar company, there is an underlying commodity there, and there should be arbitrage opportunities available for that. Would you say we're getting there?
They will have no choice, Manisha, but to be able to understand the underlying asset class rather than just purely chasing momentum. AI is doing its bit, but apart from that, you have to apply your own IQ and EQ when you are making these kind of investments. Are we yet there? Well, the honest answer is no, but are we intending to get there? The answer is yes.
All right. Vikram, this one is to you. So, well, gold is done and so is silver now. What is the kind of growth, would you say, we've seen in the last couple of years, especially now in the last couple of months where the prices have been anything but skyrocketing?
So, Manisha, if you allow me, I'll disagree with what Lakshmi says. And I think that is the problem with the development of this market in India, because when you are touting gold returns with equity returns and debt returns, it clearly shows that, it is some sort of a confusion you're creating in the minds of the investors. I mean, there are three different classes. I mean, who compares the returns of debt with equity? So why are we comparing debt of, returns of commodity with equity? Why it is being done? So I think that is the biggest problem, the mindset issue that we have, and that needs to be resolved as far as the development of the Indian market. Secondly, as far as development of the gold market is concerned, what we have seen that in a country which imports roughly about 2.5-3 lakh crores worth of gold, the AUM is not even 10% of that. So I think from here it can go even higher. And as the size of the portfolios increases, there will be greater demand for portfolio diversification. And I think that could be a story which will give traction to a higher participation of investors and funds in the gold market. So that's how I see it in the future.
So Vikram, according to you, how much should one's portfolio be commodities right now? I mean, I know we have very limited choices here, gold and silver perhaps, but how much of holding of that?
So I think if your portfolio is skewed towards fixed income, then you don't need too much of gold. If your portfolio is skewed towards equity, then you need a higher allocation to gold. And I think when there was a study done by World Gold Council, which mentioned that anywhere between 5 to 15%, anything above or below that is suboptimal. So that is the range that you have depending upon where the skew of your portfolio lies.
Lakshmi, what would you say? I mean, even if gold is a replacer in debt as a segment, how much would you want or advise holding gold?
I would say about 10 to 15% of your total 100 rupee allocation in a portfolio, I think, is fairly optimal. Though globally, there are studies which don't really give you the precise number that kind of fits best. But I think anything around this range should be fairly appropriate. And this is excluding the amount of the tons of other kind of gold in the non-investment format that one already tends to own. So I think, therefore, that around the 10-15 number, percent number, I think is a fairly sweet spot to let your portfolio be truly diversified.
All right. So if you want your portfolio truly diversified, commodities or debt perhaps is the way to go for that. And within this as well, with the kind of run-up that we've seen in commodities, even if it's for a near term or a shorter term, it does find place in your portfolio. Lakshmi, Vikram, thank you so much for joining us today and taking us through all those details and, of course, what needs to be done going forward with the kind of movement that India is seeing in sense of financialization. Commodities perhaps will have a bigger role to play. But with that, that's all the time that we have on Commodity Champions. Thank you for watching.